Okay, so you want to own a gym. Find a space, fill it with equipment, hang a sign outside, and watch the memberships roll in every month like clockwork. Walk into almost any gym on a weekday evening, and the case for the business seems to make itself. Every treadmill taken, a line at the front desk, someone waiting for a squat rack. You watch that scene and think, this place must print money. Here's the problem. That 1 hour of the evening is the most misleading hour of the entire day, because a gym does not actually make its money from the people you're watching sweat on the floor. A gym is a subscription business wearing gym clothes, and the person who signed up in January and never came back is, financially speaking, worth more to the owner than the person doing lunges in front of you right now. Let's start with what kind of business you're actually buying into, because gym is a word covering several very different operations. At the bottom of the price ladder sit the high-volume, low-price chains, the $10 to $25 a month operators that have restructured the entire industry over the last 15 years by building a business explicitly designed around low utilization. Planet Fitness, the largest of these by member count, held its entry-level price at $10 a month for roughly 27 years, before finally raising it to $15 in 2024, and the company has been remarkably candid, in earnings calls and interviews, about exactly why that price never moved. A single Planet Fitness location can carry somewhere around 7,000 members on average, sometimes north of 10,000 at a mature club, inside a building that would need to be several times larger if even a modest fraction of those members actually showed up on a given evening. That math only works because the members mostly don't show up. Company data and industry analysts have put the average member visit frequency at somewhere around 5 to 6 times a month, and roughly 60% of members don't set foot in the building at all in a given 30-day stretch. This isn't a flaw the company is quietly living with. It is, in the words of one analyst who covers the stock, a very powerful marketing tool, because $10 is cheap enough to get someone off the couch and onto the membership rolls, and just cheap enough that canceling never feels worth the hassle. Above that tier sit the traditional mid-market commercial gyms, $40 to $70 a month, with a weight floor, cardio machines, and a schedule of group classes. Above that, the luxury clubs at $150 a month or more, selling a lifestyle rather than a workout, sometimes including spa treatments and co-working lounges. Then the boutique studios, built around one style of class in a room that might be under 3,000 square feet. And finally, the one-on-one personal training studio, sometimes as small as 500 square feet, which doesn't sell memberships at all. It sells your time with a coach. Each of these is a different answer to the same underlying question. Do you make your money from a huge number of people paying a little, or a small number of people paying a lot? Before a single one of those memberships gets sold, you have to actually build the place, and this is where the naive mental model usually collapses first. The equipment is not the expensive part. Turning an empty commercial box into a space that can legally and safely hold rooms full of sweating bodies is the expensive part. A landlord will typically ask for 3 to 6 months of rent as security deposit before any renovation begins. Rubber flooring capable of absorbing a dropped barbell without cracking the slab underneath runs somewhere between $10,000 and $40,000. Locker rooms and showers need moisture-resistant materials and dedicated drainage, another $10,000 to $50,000. And then there's the cost almost nobody budgets correctly on their first attempt: air. A room full of people generating heat and moisture for hours needs an amount of fresh air that isn't a guess. It's a building code formula, and running that formula on a mid-sized gym floor at peak capacity can require a full HVAC upgrade costing anywhere from $10,000 to $50,000 before a single membership has been sold. Stack the deposit, the build-out, the licenses, the insurance, the opening marketing push, and a cash reserve to survive the slow early months, and a modest commercial gym can require $300,000 to over $1 million just to unlock the front door. Now the equipment itself, which is its own kind of trap. A commercial treadmill runs $2,000 to $8,000, and a gym floor needs 6 to 12 of them at minimum. Selectorized strength machines run $1,000 to $5,000 each, and a real gym floor needs 12 to 20 of them. All in, the equipment bill for a mid-sized gym typically lands between $40,000 and $250,000. And the decision of whether to buy that equipment outright or lease it is one of the first real strategic forks in the business. Buying feels safer, no monthly bill hanging over the operation, but it drains cash reserves at exactly the moment the business needs them most, in the uncertain early months before membership numbers stabilize. Leasing keeps monthly cash outlay small and lets equipment get refreshed every few years, but lease financing on equipment commonly carries an interest rate around 8% annually, meaning the total cost over the life of the lease runs well above what the equipment was actually worth, and the lease payments don't stop just because the gym's membership dries up. Either path locks in a large fixed monthly cost that has to be paid regardless of how many people walk through the door on any given day. Here's the part of the business that actually explains everything else, and Planet Fitness is simply the clearest, most public example of a pattern that runs through the entire budget end of this industry. Picture two people signing the same membership contract on the same January morning. One shows up 3 times a week for the rest of the year. The other shows up twice, feels good about it, and never comes back, while the payment keeps arriving automatically every single month. Which member is more valuable to the gym? It's the second one, and it isn't close. The first member uses hot water, wears down the treadmill belt, needs towels laundered, and occupies floor space during the exact hour the gym is most crowded, the hour that makes other members frustrated enough to consider canceling. Every visit costs the gym a small amount of real money and a small amount of real capacity. The second member costs the gym almost nothing at all, while contributing the exact same monthly revenue. This is why a gym with 7,000 members on the books can operate out of a 20,000 square foot building with a legal occupancy cap that might be a tenth of that number. The building only has to be sized for the fraction of members who actually show up, not the total number who pay. And a business that deliberately targets the least committed, most price-sensitive segment of the market, as Planet Fitness has openly said it does, is a business that has figured out how to turn low commitment into a structural advantage rather than a liability. This dynamic runs directly into how hard it is, by design, for people to leave. Gym cancellation policies across the industry have historically been built with more friction than the sign-up process ever has, often requiring cancellation in writing, in person, or by certified mail, rather than a phone call or an app tap, and requiring 30 to 60 days of advance notice that guarantees at least one more build cycle after the decision to leave has already been made. Planet Fitness itself required members to cancel in person or by mail for years, even while running an app used for daily check-ins, a mismatch pointed out repeatedly by industry observers before the company finally moved to allow online cancellation in 2025. Regulators have taken notice of exactly this pattern across the subscription economy broadly, and the direction of travel, even if the pace has been uneven, is toward requiring that canceling be roughly as easy as signing up. The fact that this friction was ever standard practice tells you something important about the underlying economics. A business confident that most members would actually want to stay doesn't need to make leaving difficult. There's a seasonal rhythm layered on top of all this that shapes the entire financial calendar of a gym. A large share of annual new memberships are driven by New Year's resolutions, concentrated into just a few weeks of discounted joining fees and heavy advertising spend. And that surge hands an owner a large injection of cash and a wave of new monthly billing almost overnight. The same wave that arrives fast tends to recede almost as fast. A meaningful share of new members stop attending within months of signing up, and February is widely regarded across the industry as the highest risk month of all, the point where the initial burst of motivation fades before a real habit has had time to form. Experienced owners plan their entire cash flow around this, treating the January windfall as a reserve to be spread across the quieter months rather than a permanent new baseline of revenue. The owners who get into trouble are the ones who spend the January bump as though it will repeat every month of the year. There's also a structural choice between building independently and buying into a franchise system, and the fitness industry runs almost entirely on franchising at the value end of the market. A franchise brings an established name, a proven layout, standardized software, and often better pricing through corporate purchasing deals, but it isn't free. Franchise agreements in this category typically require an upfront fee in the tens of thousands of dollars, an ongoing royalty running several % of gross revenue, and an additional marketing fund contribution on top of that every single month for the life of the agreement. An independent owner keeps every dollar the business generates, but gives up the brand recognition and buying power that can be the difference between hitting a break-even membership count on schedule or falling behind it.
Now let's talk about what happens when the underlying math breaks, because it does, even to operators who understand this business intimately. Gold's Gym had been operating for more than 50 years, a name synonymous with serious weightlifting since Joe Gold opened the original Venice Beach location in 1965, running around 700 locations worldwide by 2020, the overwhelming majority of them franchised rather than company-owned. When COVID-19 forced gyms across the country to close their doors in March of 2020, roughly 95% of the chain's locations shut down almost overnight, and the fixed costs, the leases, the equipment financing, the payroll for staff kept on to maintain the buildings, didn't pause just because the revenue did. In April, the company permanently closed about 30 of its company-owned locations. By May 4, 2020, Gold's Gym filed for Chapter 11 bankruptcy protection, listing assets and liabilities of around $100 million, even as leadership insisted publicly that the brand itself was not going out of business. The bankruptcy filing was structured specifically around the company-owned locations, roughly 10% of the total footprint, while the hundreds of franchise gyms carried on independently under their own leases. 2 months later, the German fitness company RSG Group acquired Gold's Gym out of bankruptcy for around $100 million, picking up the company-owned clubs and the franchise network. Gold's Gym wasn't undone by people losing interest in exercise. It was undone by a structure where nearly every dollar of fixed cost, the lease, the loan on the equipment, the payroll, kept arriving on schedule during the exact months when nearly every dollar of revenue simply stopped. The same pattern played out elsewhere in the industry that same year. Town Sports International, the parent of New York Sports Club and Boston Sports Club, filed for its own Chapter 11 in September 2020 and permanently closed over 100 locations. Even the budget tier operators haven't been immune since. Blink Fitness, itself built on the same high-volume, low-price model as Planet Fitness, filed for Chapter 11 in August 2024 and closed roughly 10% of its locations. A reminder that the low utilization model reduces variable cost exposure but does nothing to protect against a fixed cost structure that can't be paid down when membership growth stalls or a parent company's own finances come under pressure. So how does a gym's core engine actually work in plain mechanical terms? Monthly dues times number of members minus fixed costs. If a gym has around $30,000 a month in fixed operating costs, rent, payroll, equipment financing, utilities, insurance, and software, and charges an average of around $20 a month per member, reasonably representative of the budget tier that now dominates the industry by member count, it needs somewhere around 1,500 paying members just to break even. Below that number, the gym loses money every month. Above it, additional members are close to pure profit because, as we've already established, the marginal cost of an inactive member is close to zero. New gyms typically don't reach that break-even count on day one. It can take 12 to 18 months of steadily accumulating members before the location turns consistently profitable, and every one of those months draws down the working capital reserve set aside before opening. Annual member churn across the industry commonly runs in the range of 30 to 40%, meaning a gym with 1,500 members can lose several hundred of them over the course of a year and has to replace all of them just to stay exactly where it started. That's not growth, that's running in place. This is where a second revenue stream becomes genuinely important, and it's the one with real pricing power behind it: personal training. A trainer working purely one-on-one is capped by the number of hours in a week, and at a typical rate, the ceiling on a single trainer's annual revenue sits well under $100,000. Small group training breaks that ceiling by putting 3 or 4 clients in a session at once, each paying less individually, while the trainer collects roughly double the hourly rate of one-on-one work, which is exactly why so much of the industry has shifted towards small group formats over the last decade. The gym typically keeps somewhere around half of what a training session bills, with the trainer taking the rest as commission, and across a full roster, that split still tends to be far more profitable per hour than a basic membership ever is on its own. Upsells built into a tiered membership structure work the same way at scale. When a premium tier costs meaningfully more, but the price gap to the entry tier is narrow enough to make trading up feel easy, a majority of a chain's members can end up on the higher tier over time, quietly lifting average revenue per member without ever touching the advertised entry price that draws people in the door in the first place. Put it all together across a full year, and you get 2 genuinely different versions of this business. In the optimistic scenario, the location hits its break-even membership count on schedule, keeps churn on the low end of normal, builds a healthy personal training and upsell program alongside its base membership, and a mid-size independent or franchise gym can generate somewhere between $500,000 and $1.5 million a year in revenue, with a net margin in the 10 to 20% range, translating to an owner take-home in the range of $70,000 to $180,000 a year. In the realistic scenario, 2 or 3 ordinary things go wrong at once. Churn runs at the high end of normal. A new budget competitor opens nearby and pulls price-sensitive members away with a cheaper rate. Equipment starts needing more frequent repairs, adding another $1,000 to $3,000 a month to overhead that wasn't in the original plan. Under those conditions, that same gym can slide from a comfortable double-digit margin into a single-digit margin or an outright loss, even while the parking lot outside still looks reasonably full most evenings. And in the extreme version of that scenario, a genuine external shock, a pandemic, a recession, a landlord who won't renegotiate a lease, the fixed costs that never paused are the exact reason a 55-year-old brand with 700 locations can end up filing for bankruptcy inside of 2 months. So if you do decide to open a gym, the thing that actually determines whether you succeed was never really how many people you can get to sign up on a good January morning. It's whether you understood, before you signed a single lease, that your most reliable customer was always going to be the one who stopped showing up.